the Goldnomics podcast, with new episodes every month on iTunes, YouTube, and SoundCloud. Subscribe to stay informed. Hello and welcome to the Goldnomics podcast, where we look at global markets through the lens of precious metals. And you can keep your eye out for new episodes on iTunes, on SoundCloud, and also on YouTube. And you can like us on Facebook, follow us on Twitter. And we have so far in this series of podcasts, we looked at 2018 and what developments we can expect in the global financial markets for 2018. And then in our last episode, we asked the question, is this the greatest stock market bubble in history? And this month, we're asking the question, is the gold price going to hit $10,000? And as usual, I'm joined by Stephen Flood, CEO of Goldcore, and
welcome to this week's Money Metals podcast, helping gold and silver investors during these turbulent times. Now, here's this week's market wrap with commentary and analysis from the low-cost precious metals dealer voted best in the U.S., Money Metals Exchange.
Welcome to this week's Market Wrap podcast. I'm Mike Gleason. Well, today concludes perhaps the most incredible month the precious metals markets have seen in a decade or more. It certainly was an extraordinarily busy month here at Money Metals Exchange. A tremendous number of new buyers have entered the market in recent weeks, and we're very fortunate to welcome an increasingly large proportion of those Americans as new Money Metals customers. Over the years, Money Metals has been especially successful in attracting first-time buyers by virtue of our vast educational resources and content, our helpful non-commissioned sales team, our wide array of programs and product offerings, and our customer service philosophy. Even as we have staffed up dramatically to handle the new surges in demand over the past few months, we are actively beefing up our staff levels even further to accommodate for the ongoing growth. We are deeply thankful for your patience and trust, and we will never let you down. Well, without further ado, let's get right to this week's market update. Another big week for precious metals markets as gold prices catapulted to new record highs. The monetary metal traded as high as $1,975 an ounce on Wednesday. As of this Friday recording, gold comes in at $1,980 and shows a 3.7% or $70 an ounce gain for the week. As July comes to a close, gold is up better than 11% for the month and has advanced nearly 30% for the year. Gold's record-setting rise has been driven by Federal Reserve stimulus, dollar weakness, and strong safe haven investment demand. Even the Wall Street-centric financial media is taking note.
Gold is shining once again this morning. Spot prices touching all-time highs as the dollar index sits around a two-year low.
Those gold prices have hit an all-time high. The spot price of gold reaching a record. Gold traditionally surges in times of turmoil. In this case, the economic impact of the pandemic and those U.S.-China tensions, they are sending investors to this safe haven. But the Fed Reserve's monetary easing measures, they also have a part to play in the price of gold.
The Federal Reserve on Wednesday left its benchmark interest rate unchanged near zero, but rates are actually going down in real terms as inflation threatens to come roaring back. That's a hugely bullish factor for precious metals. On the other hand, deflationary pressures could quickly return if the Fed lets up on the monetary gas. The GDP report on Thursday showed the nation's gross domestic product contracted in the second quarter at an unprecedented annual rate of 32.9%. The collapse in economic output was offset by a surge in fiscal stimulus that caused personal incomes to actually grow overall. Additional stimulus checks from Uncle Sam are likely coming soon. At least another $1 trillion will be added to the budget deficit, which is already the largest in history. But during a pandemic and in an election year, deficits don't matter, at least not to members of Congress. But deficits do ultimately matter to taxpayers and holders of U.S. dollars. The currency is being rapidly inflated to cover up ever-widening gaps between what the government spends and what it collects in revenue. Goldman Sachs analysts this week wrote that, quote, combined with a record level of debt accumulation by the U.S. government, real concerns around the longevity of the U.S. dollar as a reserve currency have started to emerge, end quote. That's right, the investment bank dubbed Government Sachs for its pipeline to the U.S. Treasury Department is worried about the long-term viability of the Federal Reserve note. That certainly says something. Rising risks to America's fiat currency are being reflected in surging precious metals markets. Silver spiked up to as high as $26 an ounce in wild intraday trading Tuesday before backing off. We had been eyeing the $26 level as a potential intermediate-term upside target and resistance level. Spot silver currently checks in at $24.39 per ounce and is hanging on to a weekly gain of 6% or nearly $1.50 an ounce. The other white metals are diverging to the downside. Platinum prices are off 1% this week to trade at $921. Palladium, meanwhile, is registering a 4.6% weekly decline as prices settle around $2,184 per ounce as of this Friday morning recording. Concerns about automotive demand amid gloomy GDP numbers are weighing on the platinum group metals. Fears of weakness in industrial demand more broadly could deliver a hit to the silver market as well, perhaps forcing a retest of the big breakout at the $20 level. But the poor man's gold has been boosted in recent weeks by investors in both exchange-traded products and physical bullion. Bullion buying from newcomers has been furious. As a consequence, the price action in the market for silver coins, bars, and rounds has been extreme to say the least. Premiums on popular products, especially silver eagles, have surged as demand overwhelms supply. Another issue is that the U.S. Mint is now chronically failing to meet its own minting obligations. The West Point Mint has announced that in order to protect workers from the China virus, it will scale back production of gold and silver coins over the next 12 to 18 months. Clearly, this problem won't be solved anytime soon. The scarcity of American Eagle products means premiums on these coins will likely stay elevated. The good news for holders of them is that dealers, including Money Metals Exchange, will also pay elevated buyback prices in order to acquire inventory from customers actually willing to sell. There may come a time when you want or need to sell your precious metals. We are certainly happy, in fact eager, to help. But given the unprecedented and growing risks right now to the US dollar and frankly most other fiat currencies, we also urge everybody to retain at least some emergency stash of sound money regardless of market conditions. Well, that will do it for this week. Be sure to check back next Friday for our next weekly Market Wrap podcast. Until then, this has been Mike Gleason with Money Metals.
Welcome to the Gold Newsletter Podcast, your bank of knowledge of investment, economics, and geopolitics. Go to goldnewsletter.com for our publications and archives.
This is the Gold Newsletter Podcast. Fergus Hodgson, your host. Thanks for tuning in. We have a special episode. This one is more time sensitive. Brian London has called it. We've got Dennis Gartman. He is the former editor for 35 years of the Gartman Letter, and he is the chairman of the University of Akron, and he's also on the NC State Endowment Committee. So, Dennis, this has been a spicy time. I'm eager to chat with you. Welcome.
Thank you for having me. You guys scraping the bottom of the barrel, and here I am.
Dennis, I have to thank you for reacting so quickly. I read yesterday on Twitter that you had gotten out of gold. I believe you're in Fox Business and said you're out of gold now. And so I had to try and get you on the horn here and get your rationale, because I'm usually used to be so in tune with your rationale reading your letter every morning, which was such a Herculean task. I know you're glad to be... But I had to get your rationale because, your trading philosophy is so different than you see from most people, in that you find a trend that's working and you don't cut back as it goes up. You actually add to the trade and working. So gold has been working. So how does this work within your investing themes?
Well, first of all, Brian, let's say that I've been bullish of gold overtly, manifestly, continuously for the past 2.5 years. And as we were talking earlier, a bull market, whether it's in soybeans, gold, sugar, stocks, bonds, it makes no difference. I've always said that there are 3 positions that one can have: really long, modestly long, or neutral. And for 2.5 years, I was reasonably or modestly or aggressively long of gold. And suddenly it occurred to me that the number of people, the media's attention to gold, the crowded nature of the boat, as it were, was sufficient enough to make me go to the sidelines. And that's all I've done, is just go to the sidelines. It's not that I'm bearish of gold. There are times when one is supposed to be bullish. There are times when one is supposed to be neutral. And I think this is one of those times. To put it euphemistically or comically, as the great Yogi Berra once said of a restaurant that he used to frequent in New York, nobody goes there anymore. It's too crowded. Well, that's what's happened to the gold market. Suddenly you wake up in the morning, Bloomberg is talking about gold first off. CNBC is talking about gold first off. The Wall Street Journal has articles on the front page about gold first off. The Financial Times of London writes about gold first off. We haven't had that sort of activity, that sort of interest in the gold market in years. And perhaps I was premature. Perhaps I should have just simply said, instead of being aggressively long, I should have just cut it back and been moderately long. But I've gone to the sidelines. I may regret that, and for the last 48 hours, I have indeed regretted it, because gold has gone up a lot more in 48 hours. But I think in the great scheme of things, there'll be a $50 or $60 or $100 break in gold, and I'll be a buy once again. So am I bearish of gold? Not on your life. Am I bullish of gold? In the long run, yes. Will gold be higher 2 years from now than it is now? Absolutely. But shall gold be lower in the next month or 3 weeks or so than it is now? Almost certainly.
You know, so it's more of a matter of traders' intuition and
Yes.
tea leaves as opposed to any metrics. You know, I can't argue with that. My situation in Gold Newsletter, we focus on a lot of these junior gold mining stocks, which have been just performing spectacularly. I mean, some of them multiplying in value over the course of a few weeks. And the issue with speculators in that sector is once they get back in, it's very difficult for them to get back in.
Same for me.
You do have to take profits along the way, and it's a problem, it's an issue, the kind of problem you like to have, but it's a money management issue, and they tend to, or a lot of my readers tend to just stay in and ride the wave. So it is easy for somebody who's involved in the indices, the ETFs, et cetera, I guess, to get in and out and have that trader's mentality. So it doesn't necessarily apply, I would think, to a lot of investors who are involved in the individual equities.
I have tried to stay away from the individual equities just for the simple purpose that I'm afraid of walking in one morning and finding out that a mine that I bought had been watered in for some reason, or that somebody had done something unscrupulous. Or so when I trade gold at GLD, it's the easiest way, it's the most liquid way, it's the closest equivalent to being gold itself. Yes, I know that some of the far right-wing gold bugs will argue that GLD can't take delivery of it. That's another story for another time. It just, if you're a trader of gold, that's, other than gold futures, that's the best way to accomplish the task. And I had been long with gold for a long period of time. I wrote some calls against it, along with GLD for a long period of time. I wrote some calls against it last week. I got called away over the weekend, and I'm out of the market for a while. Do I wish that I were back in? Of course. Do I wish that I made the other $100 if gold has risen? Of course. Do I think that I've done the right thing? Yes, I think I've probably done the right thing. The next $100 break, and there will be a $100 break as the public gets disenamored of gold, as some untoward circumstance happens in the stock market, as some untoward news comes out, as the Fed makes a statement that perhaps it won't be quite as expansionary as it has been, or perhaps the ECB makes a comment that it will be modestly less expansionary than it has been. There will be something along the line in the next month or so that sends gold down and has the public scrambling to get out of the boat that's capsizing. At that point, I'll be right back in. So yes, call it trader's intuition, call it that. What had driven the bullet on the gold market had been the expansionary monetary policies that the Fed, Bank of Canada, the ECB, the Bank of Japan, the Bank of China had all been embracing for years, and they're not going to change that anytime soon. So, but the public had been just had clamored to get in, and the boat got a little bit overwrought.
And you know, as I said, I really can't blame you for thinking that way, because the run it's gone on has been just absolutely amazing. 10 trading days ago, we were wondering if it could get past $1,800.
Yes.
and then it just took off. Along the way, silver started waking up finally, and it's just been an amazing week and a half of trading.
Speaking of an amazing week and a half, the 15 minutes in the silver market this afternoon, silver moved to what, $2.50? Are you kidding me?
And right back.
And I'm sure it scared a lot of people out at that point. The volatility of the market is such that the participation from the public has ramped up volatility to the point where I'm watching silver and I'm watching gold, and I'll wait for the correction. It'll happen. There'll be an inevitable correction, and when it does, I'll be there as a buyer.
And getting to that, Monday night, gold sold off $50-$60 before the New York Open, and I was like, okay, that's expected, and it's not even unwelcome because we have to take some of that heat off of the market. It's really been overextended. But then it bounced right back. I'm getting, you talk about traders' intuition. After all these years of watching gold price daily, which, one of the only things I watch daily, it's amazing to me that this buying coming back into the market. I can see this run from $1,800 past through the 1920 record and overshooting. I can see a lot of that being short covering. I can see a lot of that being hot money trend following and people and just seeing that bullseye on the old record high. But the fact that it sells off and then there's another groundswell of money coming in, it seems like there's a shift globally in investor allocations, big money allocations, just a little bit toward the metals, and because of everything that's going on. And when you look at these vast oceans of liquidity sloshing around the world, and gold's this little bitty tidal pool over here, you just get a few sloshes in there, that tidal pool all of a sudden is, grows three times, 4 times in size. So we may be something a bit bigger at play here.
As the chairman of Akron, I've tried to convince my other members of the board of directors to be involved in the gold market. I thought we should have bought 10 or 15% of our portfolio should have been in gold, and I couldn't convince anybody to buy gold. Interesting is gold thus far this year has outperformed the S&P, it's outperformed the Dow. It's, I think, only lagged behind the NASDAQ by 1 or 2% at most, and maybe in the last 48 hours has surpassed the NASDAQ. And yet I couldn't get the other members of the board to buy into buying some precious metals just to offset any inflationary risk that we might have. So yeah, the slightest ripple in this great ocean of money that does indeed slosh around can move the gold market rather dramatically. Where do I think gold will be if the monetary authorities continue the same sort of expansion that they have been committed to for the past year? Where do I think gold can be 5 years from now? Will it be above $2,500 an ounce? Sure, it'll be above $3,000 an ounce. So that's my long-term outlook. And right now, it's amusing to me that if I go to the sidelines in gold, the gold bug's just accost me on the net.
The Gold Newsletter podcast is proudly sponsored by the Discovery Group of Exploration and Development Companies. To learn more about our exceptional track record and exciting future, visit discoverygroup.ca.
Hello, listeners. I am Daniel Duarte, and this is our weekly segment with the Discovery Group, which, as you all know, is a proud sponsor of the Gold Newsletter podcast. Today, I'm pleased to be joined by a repeat guest, Alex Heath. He is in charge of corporate development at K2 Gold Corp, a junior resource company focused on gold exploration in California, the Yukon, and Alaska. K2 is listed on the TSX Venture Exchange with the ticker symbol KTO. Alex, thank you for coming back.
Great. Thanks for having me.
So we last spoke with you guys in early June. Stephen Swadden, the CEO of K2, told us about the progress you're making on the Mojave project. This is in Southern California, and the soil surveys out of that project. And since that interview, you have put out 2 important press releases. First, on July the 2nd, you announced exploration results that you believe expand the mineral potential of Mojave from gold to base metals. So what exactly did you find, and how could this alter the project's scope?
Yes, happy to explain those results. So what we were showing there is the property is actually segmented into 2 areas. One is the eastern target area. It's been the focus of exploration in the past, and it's mostly based on gold results.
Right.
But we also noticed that in the western target areas, we're seeing more base metals, silver, and some gold as well. And so the news that we had out recently in July was just announcing that we had found more high results from the western target areas, which just points to the mineral potential of the overall property itself.
And the second one, the press release, is even more exciting because it says you have been granted approval to start drilling. And if I'm correct, this hasn't been drilled since the 1990s. So please tell us all about this phase 1 program and when is it slated to begin?
Great. Yes, I'm happy to do so. Yeah, so that is significant news for K2. So we received approval from the Bureau of Land Management for our phase 1 drill program, as you noted. As noted, again, you said that BHP was the last company to drill this property. It wasn't done since the 1990s. So this is significant because no systematic exploration has happened since then. So what this means for us is that we get to put in our drill program. It'll start as soon as possible, but we're targeting in August, looking at 4 different locations, 2 at the Dragonfly and 2 at the Newmont target areas, and putting 4 holes for each target area. So looking at 16 holes total, 200 meters roughly on average are the depth of the holes for overall 3,200 meters.
And so what comes next? Have you filed an application for the next program?
Yes, that's a good question. So in tandem with the application for phase 1, we put in